What's going on, everybody, in the Grand Strand? We got a big crowd here tonight. We're gonna dive in to taxes in retirement. We're gonna show a lot of cool things. We're gonna let a few more people sign on before we dive into this thing. There is a chat box, so if you can have any questions, you can just add the little chat box and feel free to reach out with anything, any questions that you have. Let's see. We got a lot of cool things to go over tonight. The information that I share with y'all tonight could potentially change y'all's lives. I'm excited about it, so we're going to get rolling here in a few minutes. And I hope everyone had a awesome Memorial Day. Is it warm in Myrtle Beach or what? Oh my goodness, I think it is, was it upper 80s today? Looks like we may get some rain tomorrow. It's going to be almost 90 tomorrow. So a lot of people have been saying that it's almost like summer already. And here we are. It is, I guess it's almost June. They say it gets the hottest around August. We got people from Long, South Carolina. We got people in Tennessee watching. We got people in Wilmington. And I really appreciate y'all coming in tonight. Okay, 6 o'clock is coming. This is getting recorded, so this will be sent out. Again, a recording of everything. But let's dive in. Let's dive in. For the people that are showing up late, that's okay. The early bird gets the worm. I've always been early throughout my life. And definitely want to get rolling and be respectful of your all's time. Taxes in retirement. That's a big deal. The IRS has a lot of things, and the new tax reform, the Tax Cuts and Job Act of 2017 has changed a lot of things. So we're going to dive into a lot of it. So let's get rolling. Let's get rolling right here. Full disclosure, I'm not a CPA. I know enough about taxes to potentially save you and your family hundreds and thousands of dollars. But when we're talking the nooks and the crannies, the right paperwork, when we're talking the right filing with the good old IRS, we do use a CPA. There's a lot of great CPAs out there. So full disclosure, I'm not a CPA. What are our goals tonight? Understand what changed with the personal income tax under the Tax Cuts and Job Acts. Understand what in the world's going to happen to your retirement income, whether it's from annuities, IRAs, whether you're still working. We're going to dive into a lot of that stuff, how much your Social Security is taxable. So we got a lot of cool things to go over. My parents were confused with the new tax reform. They didn't really understand. They tried to do research. Did they save money? Did it cost them more? They just did not know. Full disclosure, these are not my parents on this picture right here. I have no idea who these people are, but my goodness, they sure look confused. And maybe some of you have looked like that. I know I have when I did a lot of research with the tax deal. So a lot of people are confused. The beginning of taxes. Let's think about this for a second. Congress imposed its first personal income tax in 1861 to help pay for the war efforts in the American Civil War. This income tax was repealed in 1872. The 16th Amendment was ratified in 1913, which states that Congress shall have power to lay and collect taxes on income from whatever source derived. They don't care where it comes from. They want their tax money without appointment among the several states and without regard to any census or enumeration. What does that really mean? Is they can get your money. In 1913, they entered an income tax levying 1% tax on personal incomes above 3,000. Look how far we've come. And a 6% surcharge on incomes above $500,000. This was in 1913. The max taxable bracket was 7%. And you had to make over $500,000 to be in the 7% bracket. By 1918, 5 years later, the top rate on income tax was increased to 77%. They started out at 7% in 1913 at the top rate. 5 years later, it jumped to 77%. Do y'all think that's a big increase? I sure do. The top marginal tax rate reached 94% in 1944. 94%. This is our history going on right now. This isn't thinking maybe it could go up there. This was there. For tax years 1944 through 1951, the highest marginal tax rate was 91%, increasing to 92%, then back to 91 through the 50s and early 60s. Those were the top marginal brackets, were 90-something%. Let's look at a graph on the highest to lowest tax rates from way back in 1913 to where we're at today in 2019. Do you think we're at historically low levels? No doubt about it. Especially with the new tax code, over 85% of people are going to save money in taxes. 85% of people are going to save money in taxes. If you're in the 15% of people that won't, I'm sorry. There's nothing I can do for you. But over 85% of people will save money due to the tax cuts. We are at historically low levels. Let's look at where we're at today as a history as a country in the United States. Our U.S. debt today is over $22 trillion. The Social Security and Medicare trustees recently issued their annual report about these two programs. It states Social Security will be, and their reserves will be depleted in 2035, but will enter a negative cash flow in 2020. That's just next year. So we'll have to begin to remove monies from the so-called trust fund. They reported that Medicare will become insolvent in 2026. There are 79 million baby boomers, and I love every single one of you, by the way. There's 66 million Gen Xers. 140 million people are going to be over age 65 in the next 27 years. Do you think we're going to have enough money to care for 140 million people if we're having trouble caring for 60 million right now? We got 140 million people coming, and we're having trouble with 60 million right now. Are we going to need more revenue? I like to ask this question: where are we going to get the revenue? 90-some% of people say, well, they're going to increase our taxes. Maybe they could. I'm not saying they will. I'm not saying they won't, but it's definitely a probability based on the history of the United States. They could increase the taxes. Maybe they could reduce benefits. A lot of people are saying Social Security or Medicare may be means tested. Medicare, you could argue, is means tested. If you're making over a certain amount of money, your Part B, your Medicare Part B and your Medicare Part D are going to be more expensive, which we'll get to later. So they could increase taxes, maybe reduce benefits, or maybe print more money. Well, that's all good. I love printing money, but what's the overall side effect to printing money? Inflation. And what is technically inflation? It means your dollar today may not purchase what a dollar in the future, or your dollar today won't purchase what a dollar, something like that. You know what I'm saying? The dollar today is not going to purchase near enough that dollar will for in the future. Like this Yeti that I got. I love water. This Yeti I got, y'all know Yetis are expensive. Well, maybe this Yeti could be $300 in the future with inflation. So if they print out a lot of money, in essence, your benefits are being reduced. Tonight, I am going to focus on married filing jointly brackets. These are the 2019 married filing jointly. There are a ton of people that file single due to death or due to divorce, due to a lot of other things. But for the short time we got, I am going to focus on married filing jointly. However, the concepts are going to be the same if you're a single taxpayer, just the numbers are going to be different. So if you see the ordinary income brackets, the 10% bracket is 0 to 19,400. Then the 12% bracket used to be 15. The 22% bracket used to be 25. But due to the tax cuts, these brackets were lowered, which means, I'm going to say it again, 85% of people are going to save money. What a great time to potentially do some serious planning. However, if you've ever done a tax return, you understand only the thin income is taxed at those rates. This is called your marginal tax bracket. It's the dollar your last, it's the tax bracket your last dollar falls into. What do I mean by that? Well, you see on the screen, from 0 to 19,400, 10% of that is taxed. So you're getting taxed at 10% in that bracket. But then anything above 19,401 is going to get taxed at 12%. So if you got a guy making 30 grand in this example, you take the 30,000, subtract the 19,401, and that 11,600, only that 11,000 is taxed at the 12%. The rest of that stays inside the 12%, the 10%, or maybe even falls into that standard deduction. So only the thin income is taxed into that upper tax bracket. This is an ordinary tax map, an ordinary income tax map. I have the software. I personally have the software to run you a tax map. If you're interested in a tax map and thinking about doing some planning, shoot me an email or give us a call later tomorrow, or you can email me tonight, or respond in the little chat box here tonight. That will definitely get that to you. But if you want a personal tax map, I've got the software to run you a personal tax map. What's this tax map really tell you? Well, it shows all ordinary income tax streams. Where are our areas of planning? Well, let's look at it. The 12% bracket. The 12% bracket is a huge area to plan. Why is that? Well, what's the very next bracket outside of the 12%? It's 22%. It goes from 12% to 22%. Well, that doesn't sound like a whole lot, Reid. 22 or 12, that's not a huge difference. That's almost 100% increase on your taxes. That is almost 100% increase in taxes. Where's the next area of planning? The 24 to 32%. That's over a 30% increase in your taxes. And look how long that line is. That's a long line. You can take some substantial money out and stay in that 24% ordinary income tax map. The marginal tax rate, that's the tax bracket your last dollar fell into. I'm going to throw a lot of terms about a lot of things out, not to confuse you, but to try to give you the most amount of value I possibly can. The marginal tax rate versus effective tax rate. The marginal tax rate is the tax bracket your last dollar fell into. And that example I gave a little bit ago, where the person was making 30 grand, their marginal rate was 12%. So if they took out an additional bracket, $1,000, it'd be in the 12% bracket. But is that their effective rate? Well, we're going to dive into that a little bit later too. Capital gains. What a great time to potentially have some capital gains. Capital gains rates, in my opinion, are as low as they will ever be. Why is that? Why do they give such favorable taxes to capital gains? Well, it's to encourage investment. They want to spur the economy. Think about, regardless of where you stand in your political views, think about the economy since Donald Trump's gone in. What did he do? He reduced taxes. Now everybody and their brother is trying to invest and grow their money, grow their business, and the economy is just flourishing. We're at the lowest unemployment rates we've ever seen, which is awesome, or at least in a long, long, long time. And people are excited about where the economy is going. Is it scary? Well, yeah, it is scary too. We won't get too much into that. But the reason capital gains and qualified dividends get different treatment is to encourage investing. Here's the capital gains brackets. From married, filing jointly, we're still focusing on that. But from 0 to 78,000, if your taxable income is from 0 to 78,000, you are in the 0% capital gains. 0. Do you think ever in the history of the world that you'll ever be able to literally make up to 78,000, and if your taxable income's up to there, that you pay 0 in capital gains? What a great time to possibly take some profits off the table. What if you're not making any other income and you have some substantial capital gains? I'm talking some big time 6-digit capital gains. You can sell up to $488,000 in capital gains tax and stay in the 15% bracket. That is unbelievable. If the first thing that I said when you got online here tonight was, I can show you how to take almost $500,000 and stay in the 15% bracket, what would you have said? You'd have called me crazy. If you got $500,000 in capital gains, you can sell it and stay in the 15% bracket. Isn't that nice to know? I told y'all, I may literally save you and your family hundreds and thousands of dollars with tonight's information. Here's the capital gains tax map. So what we went over earlier was the ordinary income tax map. What I'm showing you now is the long-term gain in qualified dividends tax map. You see the 0%? If you look really closely, I know it's kind of hard to see, but if you look close, you can see that that 0% actually goes over $100,000. Why? Because that's why that's with the standard deduction. So with the standard deduction, you could literally have over $100,000 of capital gains and not pay a penny in taxes. It's a great time. A lot of people say, hey, I've got some monies in the market. I don't want to get smoked in taxes. Well, I'm proving to you right now, it may be a great time to possibly, and the purpose of investing is to have a gain, right? The IRS wants their share though. Good old Uncle Sam. Deductions, exemptions, and credits. Deductions, exemptions, and credits are where a great CPA holds his weight in gold. This is worth, a CPA is worth his weight in gold if he can help you with the deductions, exemptions, and credits. There's a lot of things they got to file just right. They got to be within either a lower income rate, maybe have very low income, maybe have some things happen that you got to have the right paperwork, but can really take advantage of that. We'll talk a little bit about it, but a true CPA is really who can possibly help you with some deductions, exemptions, and credits. What is a deduction? It's an amount deducted straight from your taxable income. The standard deduction was doubled this year, or last year rather, for 2018. It actually went up another $400 this year. So a standard deduction is $24,400 for a married couple. That's a big deal. You basically get, if you can literally make up to $24,400 if you're married, filing jointly, and basically tell the government, hey, I didn't make a dime, and not pay a penny in taxes. What about a single? Well, it's a lot less. It's half of that. It's $12,200. Itemized deductions. Can you write off mortgage interest anymore? Yeah, up to $750,000. What about the home equity line of credit? Do you get to write off that interest anymore? There's a lot of things you can and can't do with the home equity line of credit. Based on everything that I know, if you're improving your house with that line of credit, you can. But you can't just take out that home line of credit go buy a vehicle or something, or go take your kids on a nice vacation to Disney World and write that interest off anymore. Charitable gifts of cash or check up to 60% of income. You can write off charitable gifts as always, but what if you're using the standard deduction? Do you get to write off your charity gift? What if you file for the standard deduction and you give a couple $1,000s to the church, but you're still in that standard deduction? Do you get to technically write that off? Well, with the standard deduction you do, but you don't get that separate break for that. That's a big deal. I personally think we may end up seeing some changes in that, because people like to give and people like to get a write-off for it. But if you're using that standard deduction, you don't get a direct write-off for that charity gift. So when you're talking qualified charitable distributions, maybe you could take some of your required distribution, have it sent straight to the church, and get it written off that way. Now we're getting into the weeds of the tax planning, but that's some stuff a personal appointment may work out for. You do get an additional deduction for being 65 and up. That's why being 65 is the real deal. I can't wait to get to 65. You get on Medicare, you get an extra deduction. 65 is the new 50. Y'all are rocking and rolling out there playing pickleball, playing tennis, going on river cruises, buying homes, selling homes, going out on dinner dates. I hear it all the time. Y'all got it made in the shade. What about this? Do you get an exemption for being alive anymore? You know, you used to get a personal exemption. Everybody in the household got a personal exemption. Do you get that anymore? That's a cute baby though, isn't it? That's a super cute baby. For those of you that don't know, is I am an uncle now. My brother-in-law, which is Richard Berry's son, Jordan Berry, him and his wife had a little girl back in December. Let me get a picture. Let's see if y'all can see this. Look at that. That's me and my little niece. That's me and my little niece, Caroline. That's her. So she is beautiful. She's going up on 6 months. My sister's pregnant right now. So I'm having a little nephew. I like to consider myself the best uncle in the world, if I'm being honest. But do you get the personal exemption? No, you don't. My little niece is cuter than that baby, so let's get that baby off of there. You do not get the personal exemption anymore. So for people with big families, maybe that hurt them a little bit. Maybe they wish you did. Credits. Let's talk a little bit about the credits. When it comes to the credits, you got a healthcare tax credit. What's that mean? To get that credit, you typically got to have really low income, and you typically got to have some fairly substantial health issues going on. Won't talk into too much about that, but if you've got really, I'm talking low, like below like 20 grand of income, and if you've had some health issues going on, you may qualify for a tax credit. Earned income tax credit. Are most retirees earning any money? Most of them aren't. Most of them are retired. They're out there spending money, as you should. They're not earning any income. Education credits. Are most retirees going back to college? No, most retirees they're saying, I'm done learning. Y'all on here tonight, we got a lot of people on here tonight. You're learning, you're getting it. And as a matter of fact, since you joined me tonight, I'm giving you $1,000 education credit. Just do not tell your CPA to call me. I won't answer my phone if your CPA calls me, but I'm going to give you a tax credit for learning some stuff. What about the savers credit? Are most retirees saving money? No, you should be spending it. You're in the golden years. What about the child credit? Do most retirees have young children? Maybe you should. Maybe you should. Y'all just saw that little baby on there. Everybody loves a good little baby. If you're looking at getting a nice credit for having young children, maybe you should. I did say we're focused on married tonight. Okay, let's get off of that. Let's look at an example. Deductions, exemptions and credits example. Let's say we got a married filing jointly couple. They're bringing in 38 grand. Minus that deduction, you see right there on the screen, they get to write off 24,400 right off the top. That's the standard deduction. Then here we go with that 65 and up. That's what your extra deduction is for being over 65. It's 1,300. So what do we know about these people? We know they're both over 65. That's why they both get that $1,300 deduction. I'm also focusing on federal tax rates. I'm not counting states. States all have their different things. I know North Carolina's got around a 5% flat tax rate. South Carolina's got a progressive tax rate system up to 7%. And let me say this, we have a progressive tax system. That's what I meant to say a little earlier when I was showing all those tax brackets, because it goes from the 10, then up to the 12, then to the 22. Because we have a progressive tax system and only that thin income is taxed, that's why there's such great areas to do some real planning. So let's go back to the example. They get the 24,400 standard deduction, then $1,300 per person for being over 65. So that's 27 grand, boom, right off the top, as if that they never made it. They're saying IRS, not me. Then they contribute to that IRA. They contribute $2,000 to an IRA. So what else do we know about these people? Well, we know they're still working, because can you contribute to an IRA if you're under or the age group we know is they're under 70 and a half too, right? So because can you contribute to an IRA if you're not working? No, you can't. Can you contribute to an IRA if you're over 70 and a half? No, you can't. If you are working and have a 401k, a 403b, a TSP, a profit sharing plan, if you are still working past 70 and a half and you have one of those plans with your employer, you can contribute. But past 70 and a half, you cannot contribute to an IRA. So they deduct the $2,000 for an IRA. So you see their income subject to tax is 9 grand, which falls in the 10% bracket, $900 federal tax. Then they get that $1,000 credit. These people made $38,000 and didn't pay a penny in tax. What a great time to be alive. These people got it going on. So let's look back at the tax map again. Here we go at the tax map. That's the deduction right off the gate. If that's all there was, it'd be kind of simple, wouldn't it? But that's not all there is. Because now we're going into the real tax system. The purpose behind my retirement tax seminars I do, the purpose behind this webinar, the purpose that I believe I could potentially save you and your family hundreds and thousands of dollars is the real tax system. Because when you mix required minimum distributions, capital gains, what's that do to your Social Security benefits? Medicare premiums, what happens to that if you pull out too much pre-tax money? Potential Roth conversions. Are Roth conversions a good idea? Roth conversions are getting huge. They're getting absolutely huge. I had a gal come in and see me from one of my seminars. She didn't want to talk about her investment money. That's okay. But she said she was very concerned because she was 65 years old. She was a single gal. She was very concerned about her required minimum distributions one day. She said, Reid, I don't want to get smoked in taxes. She said, I got about $130,000 in a pre-tax IRA, an individual retirement account pre-tax, 130 grand, and she had about $10,000 in a Roth IRA. With her income, or she was 65, so she had 5 years before she turned 70 and a half. Well, we know at 70 and a half, the government's going to make you start taking money out. Why in the world are they making you take it out? They want their tax money. The IRS has a lien against your account. A third of it is the government's. Do you really think that it's your retirement money or it's the government's? Well, it's still yours. I'm talking to you a lot about a lot of things, and what a great time. The taxes are not very high. We are at historically low rates, so it's a good thing. However, at the end of the day, when you start taking out some good money, or maybe you got good income, you know somebody is out there too. You may be married, filing jointly, but there's a third party, and his name is Uncle Sam. So let's go back to it. She had 130 grand in a pre-tax account and like 10 grand in a Roth. I did my little tax map thing with my tax software. I said, hey, why don't you convert like 25,000 a year and stay in that 12% bracket, right? Stay in the 12%. She was totally fine with that. She said, Reid, I'm totally cool with the 12%. I said, why don't you convert over the next 5 years till you reach 70 and a half, do like $20,000, $25,000, $30,000 conversions to your Roth IRA. I said, stay in the 12%, because do you think you'll ever pay less than 12%? She said, no. And I said, fast forward age 75 or 70 and a half, you'll have zero money in your IRA, and your Roth IRA may be like 150 grand, 180 grand. Question: at 70 and a half, is the government going to make her take monies out of her Roth IRA? No, they're not. She is definitely paying tax on the conversion. I want a very important point. She is going to be getting a 1099 for that $25,000, $30,000 every year. She's okay with that. She knows it's going to happen at some point. She'd rather be proactive about it than passive with it. But at 70 and a half, let's say she's got 180, 200 grand in her Roth IRA. Will she have to pull monies out? No, she won't. What if, with the tax law sunsetting in 2026, when they see some changes, what if she waits till she's 75, and now that 180,000, maybe it's grown to 250? Then what if she takes $100,000 withdrawal from her Roth IRA at 75, and she takes 100 grand out? Will she pay any tax on that Roth IRA withdrawal? No. What if this gal doesn't need the money at the time? What if she lives to be 95? What if she has 250 at 75 in a Roth IRA? What if she lives another 20 years and that 250 has grown to 500 grand? And then she dies and never needs it. Will her family pay any tax on that 500 grand? No. Do you think I saved that lady hundreds and thousands of dollars? As a matter of fact, the longer she lives, the more money she saves. Could they change the tax laws? Yeah, they definitely could. Based on history, though, you typically get grandfathered in. So if she's got all this money in a Roth IRA and they don't change those rules till 10, 15, 20 years, based on history, she'll get grandfathered in. That money's going to be tax-free. What's the best kind of money? Tax-free. Free money is the best. How do required distributions work? They happen the year you reach 70 and a half. Based on what you're hearing with the Secure Act, depending on how many people are out there are listening to that, based on what you hear with the Secure Act, they're really kind of wanting to increase the age that you take required distributions to like 72. Will that happen? I don't know. It's not enforced right now. So as it stands right now, the year you reach 70 and a half, you must take a required minimum distribution. How they look at it? They look at the account balance on December 31st. So let's say I turn 70 and a half this year. Let's say next month I'm turning 70 and a half. They look at my account balance on December 31st of 2018. Let's say it was $500,000. Based on that $500,000 on December 31st And then based on that life expectancy, that it is a life expectancy table, the first year is like 3.65%. When you divide it by 27.4, it turns out to be about 3.65%, which means they're going to make me take out of my $500,000 IRA. They're going to make me take out $18,248. What if I don't want it? Doesn't matter. They're going to make me take it out. Well, what if I'm a rebel? What if I just say, I'm not doing it. I'm not taking out that money. Do they penalize you? 50%. The government will take 50% of your required minimum distributions if you don't take it out. And then they're going to tax you on the other 50%. They are not playing around. They are not playing around. This is the life expectancy table. As a matter of fact, your required minimum distribution increases every single year. Let me take that back. The required minimum distribution percentage increases every year. Why does it increase? Because your timeline is doing this. And as your timeline is doing that, the government wants to make sure to get your money out, because their goal is to make you spend your money down because they need their tax money. We got $22 trillion in debt. So they want their tax money. Now, you may say, well, Reid, my required distribution is really staying about the same, or maybe even going down. Well, what's happening? Your account balance, every time you take monies out, is dropping. So even though that percentage is going up, if your account balance is going down, correct, your required distribution may stay the same. Well, here's the good news. It may not hit you hard on taxes. Here's the bad news. You're going broke. You're spending your puppy down. You're spending that money down. What if, let's go back a slide. What if you got $500,000 and it's all invested in the stock market? Let's say you're being risky with it. Let's just say we know I got to take it out. I got to take that $18,000 out by December 31st of this year. I could technically wait until April 1st of next year, but then I'm going to have to take another one out. Without getting too complicated, 99% of people take it out this year in this example. Well, let's say my 500 grand is invested. And let's say the market gets ugly. We're going into like a 4 week slide in the market. Let's say the market gets ugly though, and by the end of December, my $500,000 is now $400,000. Well, now I got $100,000 less than I had. Do I still have to take out that $18,000? Yes, you do. Guess what? If it's invested in the stock market and the government's making you pull monies out, it's called systematic withdrawal, or it's called sequence of returns. You could be on your way to losing a lot of money. But here's the life expectancy table. The government percentage that they make you take out is the lowest during your 70s. Well, when do most people want to spend their money? In their 70s, right? Because we found that there are 3 stages of retirement. We got almost 3,000 clients, manage over $450 million. We found that there's 3 stages of retirement. The first stage we call the go-go years. It's when you're going, you're moving, you're grooving, you're going on river cruises, you're seeing the grandkids, you're shagging up at Fat Harold's in North Myrtle Beach. I know y'all know how to dance. Then the second stage we call the slow-go years, or the slow years. You still got it. Maybe you're just not dancing as fast. You're sitting down every 3 songs. And then the third stage is the no-no years. You don't even know where you are anymore. And if you do, physically you can't do anything about it. And guess what? Lord willing, if I live long enough, I'm going to get there too. So what I'm telling you though, is if you're in the go-go years, you need to go. And the government's going to say you're only taking out the least you'll ever take out during your 70s, and they want you to take out the most during the 90s. Well, most people aren't doing anything in the 90s, right? And then you really leave yourself open to the widow's tax, because we're focused on married filing jointly. What that means, the widow's tax, is when one of y'all, when one in a married couple happens to go meet Jesus, even though they may be receiving less income, they're going to be paying more in tax because the single taxpayer are not near as favorable. Let's keep moving. Mutual funds pass through phantom gains. To save some time, I'm going to skip through that. Is Social Security taxable? This is the most confusing part of my presentation. Is Social Security taxed? It depends. Now I'm going to show you how you calculate it to determine how much of your Social Security is taxed. Here is the calculation. This is the first step. If you're wanting to know if your Social Security is taxed, here's the very first step you got to take. You take 50% of your Social Security benefit. So now I'm counting, this is the provisional income. You take 50% of your Social Security benefit. You add any ordinary income. What's ordinary income? Earned income, IRA withdrawals, things like that. You add in dividends and capital gains. Then you add in non-taxable interest, very specifically municipal bonds. Cash value life insurance and Roth IRAs do not count into that. The only two ways to get real tax-free money, cash value life insurance and Roth IRAs. So Social Security tax, let's look at it. First step, you calculate the provisional income, half of Social Security, and all these things. So let's look at some examples. After you calculate your provisional income, you look at these benefit tax thresholds. As a single taxpayer, we got the first threshold being $25,034, but let's focus again on married filing jointly. It's not saying you see the $32,000, the first bracket, and then 44. That's not saying that 50% of your money's taxed or your Social Security's taxed. That's not saying that. This is the threshold. You get provisional income and then the threshold. So let's look at some examples. We got a couple. They're making 20 grand of Social Security. And then they take out $40,000 of an IRA withdrawal. So their provisional income is 50 grand. Well, how in the world we get that? Half of Social Security plus full ordinary income withdrawal. Half of social is 10 plus 40 is 50. Then we apply these thresholds. So we know we got 50 grand of provisional income. So let's focus on the married jointly tax thresholds. You take 50,000 minus the first threshold is 32 is 18. You take 50% of 18, which is 9,000. Then you apply the second threshold. 50,000 minus 44 is 6. You take 35% of that because the other money's already been taken at 50%. Now you got 2,100. So these people's Social Security benefit, 11,100, is technically taxable. Does that mean it's taxed at 55%? No. Does that mean that all of that money is going to be taxed? No. But that is the number you put on your tax return. 55% of these people's Social Security is taxable. That doesn't mean it's taxed, but it is taxable. So let's look at another example. Now we got some people who really waited for Social Security. Their Social Security is $40,000. So then to supplement their income, they only need a $20,000 IRA withdrawal. So what is their provisional income? $40,000. How in the world did we get that? 40,000 of Social Security. So half of that is 20 plus 20,000 ordinary income. 20 plus 20 is 40. Let's apply that threshold. 40,000 minus 32 is 8. You take half of that. Then they're not even over the second threshold. So these people's taxable Social Security is only 10%. That's not saying it's taxed at 10%. That's not saying 10% of it is taxed. That's saying 10% is taxable. 10% of it goes on on the tax return. Well, let's think about this for a second. What are these people really, what's their overall income? The first couple is 20,000 plus 40. Their overall income is 60 grand, but yet they got 55% of their Social Security tax or taxable. What's the second people? 40 plus 20. Their income is 60,000. Yet they're only in the 10% of taxable benefits, Social Security. These people are living off the same amount of income, yet one person's going to pay more in taxes. So now we take those numbers and we put it on the return. Let's look at the first couple again. 11,100 is total taxable Social Security, 55%, plus 40,000 IRA withdrawal. So their total taxable income is 51,100. Minus all those deductions, 27 grand right out the top. That's huge. Their net taxable income is 24,100. They paid 2,500 in federal income tax. So they made 60 grand, but had to pay 2,511 in federal income tax. How much do you think the next people paid? The people that really waited on the Social Security and only had 10% of it taxable. Let's look at it. Zero. These people did not pay a penny in taxes. These people are living off 40,000 of Social Security and 20,000 IRA withdrawals. They got $60,000 of total income. And how much tax did they pay? None. Why? What's the difference? They waited for Social Security because at the very most, Social Security, only 85% of it is taxable. At the very most. So here's a question. Could taking Social Security early cost you and your family thousands and thousands and thousands of dollars? Yeah. Let me change the question. Could waiting too long to start your Social Security cost your family thousands and thousands and thousands of dollars? You better believe it. So what's the right answer? Really, there's not one. It's all specific. But at the end of the day, Social Security is growing your payment at 8% every year you wait. And at the end of the day, at most, 85% of your Social Security is going to be taxed. 100% of your IRA withdrawals, your 401ks, your 403bs, your TSPs, your profit sharing plans, all of that's considered taxable money every dime you take out. At most, Social Security is 85%. Should you wait for Social Security? Maybe. Should you turn it on? Maybe. That's the question you need to ask me after this presentation. Medicare excess premiums. Now we're getting into the means testing. If you're from $0 to $170,000, your Part B premium for this year or monthly is $135.50 a month. That's this year. It's $135.50 a month for Medicare Part B. I've been doing this 5 years now. When I first started, Medicare Part B was $104. Then it went to like $120 something. Now we're up at $135.50. They're already saying we're going to get an increase potentially for 2020. Will those increases keep coming? We got $22 trillion in debt, and Medicare is supposed to be insolvent in 2026. Chances are, yes. What if you take too much money out? Then you got to pay more for your Part B and Part D. So when you're doing this tax planning, it's very important to keep your income lower than those levels. There's no point in paying more for Part B and Part D in Medicare if you don't have to. That's what a cool tax map can show you. Effective marginal tax rate. Okay, we're coming down to the end. It's been a quick 45 minutes for me. But how much of your last dollar do you actually lose to Uncle Sam? Let's look at a case study. Let's look at the ordinary income tax map again. This is what I've got software to give you. Let's look at the long-term gain and dividend tax map. Now let's do a case study for the real tax system. We got John and Jane, married, filing jointly. They're over 65. They got 5 kids. They got 15 grandkids. They got it made in the shade, happily ever after. They're bringing in $60,000 combined Social Security. So what do we know about these people? They waited. They waited a long time, but they got $60,000 of combined Social Security. They got $15,000 of net long-term capital gains. That's not a crazy amount by any means. Their required distributions total are $45,000. Well, that could mean two things. We know these people got some good money, but if they're real old, that's a high percentage. I mean, the older you get, the higher percentage the government makes you take out. So what in the world does these people's tax map look like? Wow. Wow, Reid. This is what these people look at on their tax map. What's the very first bracket that these people reach? 18.5%. Reid, you just spent the last 45 minutes telling me I can be in the 10% or I can be in the 12% bracket. And then you show me where people are in the 18.5% tax bracket initially. But then what do these people go up to? 49.95%. Are these people getting taxed at 50%? Right there. You see it on the screen. 49.95% of those people dollars that they take out during that time is taxed at 50%. Who gets they get 50%. Who gets the other 50%? The IRS, the Internal Revenue Service. What's that really mean? Internal Revenue Service. Their job is to get revenue. Do you think they're getting it with these people? They're taking almost 50% of some of their monies. That's unbelievable. Reid, how in the world does that happen? Well, let's look at it. What do you think should happen? Well, I took $1,000 out. I'm in the 12% bracket. I'm pulling out $120. That's what I think should happen. Here's what actually happens. They take out $1,000. They're in the 12% bracket. That's their marginal bracket, 12% at 120, right? But then what's that do? That causes another $850 of Social Security to be taxed at 12%. It's another $102. Then that $850 causes an additional $1,850 of the capital gains tax at 15%. That's $277.50. Game over. The government just got 50% of these people's monies. Wow. Because when you mix required distributions, capital gains, your Social Security benefits, when you mix all these things, it's not as plain Jane simple as you're taught to believe, which is why rules have totally changed when you're talking about taxes and retirement. Don't you think these people knew that they could potentially have done some planning that wouldn't cost them 50% of some of their monies? I do, all day long. Look at their capital gains. Look at their capital gains. Reid, you told me earlier you could take up to almost $500,000 and stay in the 15% bracket. You could pull up to $100,000 and pay 0% in capital gains. But how much did these people pay? 10% right up front, and then some of their capital gains went up to 38% in tax. Oh my goodness. See, the 401ks didn't come out until the late 70s, but got big in the 80s and 90s. Well, do you think the Internal Revenue Service would do anything that wouldn't help them bring revenue? I don't. And guess what? For some people, there's not a lot of planning you can do. But for some people, there's some substantial planning you can do to make sure you and your family get your hard-earned money and not the IRS. Tools for control. Should you do a Roth conversion? Maybe. Should you keep some monies in after-tax accounts? Maybe. With IRA monies, properly blend withdrawals from different accounts. It really depends. It's all tailored to your situation and what you're trying to accomplish. That's why I hosted this webinar for a lot of people. Please reach out with any questions. I'd love to give you a personal tax map if you're interested in the planning. Conclusion, your personal tax map varies greatly based on your personal circumstances. How true is that? Everybody's different. Everybody has different flavors that their mouth likes. They got different things they like, whether it comes to food, trips. Some people love the heat. Some people are like, oh man, I love 87 degrees. Some people are like, holy smoke, I'm moving back up north. Well, I don't know if anybody's saying that, but you could. Let's look at an example though. I'm gonna make you feel good right now. Let's look at an example maximizing the 12% bracket. The average Social Security per couple average is 30 grand. That's combined per couple. Well, then you use the standard deduction of $27,000. So you could take out $27,000 of pre-tax money. Then you could max out the 10% bracket of $19,400. Then max out the 12% bracket of $59,000. You could pull out $135,950. How much of that's taxable? Only $131,000. That's almost all of it. So let's think about it. Your total income in this example is $135,950. How much did you pay on that standard deduction of $27,000? Zero. In the 10% bracket, you paid $19,400. The 12% bracket on $59,000, you paid $7,000, and then on the last $25,000 in the 22% bracket was $5,610. Total tax paid was $14,696. So what does that mean? You could withdraw $105,000 of fully taxable money and pay $14,696 in tax. So what's that really mean? Now this is powerful. I really want y'all to get this, and we're getting off of here and we're calling it a night. You could withdraw $135,950 of Social Security and fully taxable money every year for 20 years for a total of $2.7 million of fully taxable money and only pay less than $300,000 in tax. That's less than 11% effective rate. So you could literally transfer $2.7 million to you for you and your family and stay in less than the 12% bracket effectively. That is so strong. That'll never happen again, in my opinion. Let me leave you with this. What a judge wrote, an American judge wrote, a United States of American judge, said that anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There's not even a patriotic duty to increase one's taxes. Donald Trump got questioned about his tax return, and they said, Donald Trump, they said, how did you not pay any taxes and you make millions and billions of dollars? You know what he said? Because I'm smart. 95% of the tax code is to help you save money in tax. I know it does not seem that way, but 95% is supposed to help you save money in taxes. That's what the wealthy do, the millionaires, the billionaires, and now even you can do it too with some right planning, the right knowledge, which I was hoping to give you today, maybe more on a personal level. This is me, my wife, and my golden doodle Chance. He's my buddy. He's about 2.5 years. He's full grown now. That dude is about 75 pounds. My wife and my dog mean the world to me. I'm the most blessed person you will ever meet in your entire life. I've had an awesome time with y'all tonight. I hope you have a great night. I love you guys. I'd love to hear from you either via email. Please reach out or call our office tomorrow. The office number is the Myrtle Beach number is 843-808-9850. and you'll be getting an email with a recording and all this stuff. Listen, y'all have a great night. Hope to hear from you soon. God bless.